Gold moved $301 in a single session, not over a week, not over a month, one day. The largest one-day dollar gain since 2008, since Lehman Brothers, since the moment the entire financial system nearly collapsed. That's not a rally, that's a repricing event. That's the market screaming that something fundamental just shifted beneath the surface. Silver moved 14% in the same session. When gold and silver move together like this, when they both gap violently higher in synchronized motion, it's not speculation, it's not retail FOMO, it's the system itself recalibrating what money actually is. I am Ken Au. Welcome to the Vault. Today we expose the physical supply crisis, and by the end, you'll know if 71 was the bottom. But here's the part that should terrify anyone still sitting in cash. While gold was printing the largest one-day gain in 17 years, while silver was ripping 14% higher, the physical market was sending a completely different signal. Bullion Star, one of the largest and most reputable precious metals dealers in Asia, posted an emergency update. Physical silver is near impossible to source right now. Mints closed, refineries backlogged, most competitors completely empty. They have inventory only because they planned ahead months ago. But even they've had to reduce minimums from 20,000 Singapore dollars down to 10,000 just to maintain any access at all for retail buyers. This is not normal market behavior. This is not a temporary disruption. When one of the most connected dealers in the world tells you they can't source metal when they're lowering minimums because supply has become that constrained, you're watching the physical market disconnect from the paper market in real time. And the gap between those two realities is about to become a chasm that swallows everything in its path. Let me show you exactly what happened. A few days ago, I released a video walking through a critical technical scenario. I said if we're trading above $100 and the price closes below the 150 exponential moving average on the hourly chart, we could see a move toward the early 90s as potential support. The price initially bounced exactly as outlined. Then I followed up with another analysis about the Fed chair announcement and how that catalyst could push us even lower, potentially below $86. For many watching, that perspective was helpful. It wasn't a prediction, it was a scenario to plan for, a framework to understand what might unfold if certain conditions triggered. And it played out. The price crashed through 86. It kept falling. It bottomed at $71, a 40% collapse from the 118 high. The largest percentage crash in silver's modern history. Bigger than 2011, bigger than COVID, bigger than 2008. Everything that could go wrong did go wrong. Margin hikes, forced liquidations, Bitcoin breaking key support, global bond yields spiking, war headlines escalating. The perfect storm of paper selling pressure hit the market all at once. But then something changed. Gold moved $301 today. Silver moved 14%. We rallied from 71 back toward 85, a 20% bounce off the lows. And now the question everyone's asking is simple. Is 71 the bottom? Is this where we turn? Or is this just a relief rally before the next leg down? Let me show you what the data says, because the answer isn't clean. It's not black and white. The physical market and the paper market are telling completely opposite stories right now. And understanding that divergence is the only way to navigate what comes next. This is where things stop making sense. First, the technical picture. The 150-hour exponential moving average, the same indicator we used to call the move below 86, is now sitting at $96. That's critical. In the previous analysis, that level was acting as support. When we were trading above it, it was the floor holding the price up. But now, after the crash, we're trading below it. And when support breaks and price falls beneath it, that support becomes resistance. The 150 EMA at 96 is no longer the floor, it's the ceiling. We're currently at $85. That's $11 below the key resistance level. And here's what matters. In yesterday's video, I mentioned the possibility of a move toward $87 to $90. Why that zone? Because at the time, we were trading around 80, and that level represented a confluence of technical factors. Fibonacci retracements, prior support zones, volume profiles. It was a logical target for a bounce off the 71 low. We didn't hit it yesterday, but today the price touched exactly that zone, 87 to 90. We tested it, and we got rejected. The bulls tried to push through. They couldn't hold. The price got shoved back down to 85. And that rejection matters, because it tells you there's real resistance overhead. It tells you the sellers are still in control at those levels. So here's the bearish case, the one that says we're not done falling yet. The 150-hour EMA at 96 is now downward sloping resistance. When a key moving average flips from support to resistance, that's a bearish technical structure. It means the trend has reversed. We tested the 87 to 90 zone. We got rejected. We're back at 85. If we can't reclaim 90 and hold above it, the next move could be lower, potentially retesting the 71 low, maybe breaking it, because the forced liquidation pressure hasn't fully resolved yet. Look at Bitcoin. It dropped below $74,000 for the first time since April 2025. That's Michael Saylor's cost basis. MicroStrategy's entire Bitcoin position is now underwater. Billions of dollars of leverage sitting in the red, and Bitcoin and silver have been correlated for months. When Bitcoin breaks down, silver follows. When crypto crashes, risk-off sentiment spreads across all speculative assets. The S&P 500 closed down 0.8% today. The Nasdaq declined 1.5%. The Wall Street Fear and Greed Index is back at 39. We're in fear territory. Not panic yet, but fear. And fear kills rallies before they can build momentum. Then there's the bond market. Global bond yields are spiking. The German 30-year bond yield climbed to the highest level since 2011. The U.S. 10-year Treasury yield is approaching the highest level since August 2025. The Japanese 10-year yield is near the highest since 1999. This is systemic stress. When bond yields spike globally like this, it means investors are dumping bonds. They're demanding higher yields to hold debt. They're pricing in inflation risk or default risk or both. And when bond yields spike, everything else sells. Stocks sell, commodities sell, metals sell initially. The initial reaction is always liquidation, raise cash, wait for clarity. Only after the panic subsides does the safe haven bid kick in for gold and silver. And then there's geopolitics. Reports of the U.S. at war with Iran are breaking headlines. If true, that's a major catalyst. But here's the trap. The initial reaction to war is not a gold rally, it's risk-off liquidation. Sell everything, raise cash. Wait to see what happens. Only after the fog clears, only after the initial shock passes, does the sustained safe haven buying begin. So if the Iran situation escalates further, if military conflict intensifies, we could see more volatility before the real rally starts. We could see another flush lower before the turn. That's the bearish case. The 150-hour EMA at 96 is resistance. The rejection at 87 to 90 is a warning. Risk-off sentiment is spreading. Bond yields are spiking. Bitcoin is breaking down. Iran war is escalating. More downside is possible. The bottom might not be in yet. This is where the system starts leaking. But now let me show you the bullish case, the one that says the bottom is already behind us. And this case is built on one undeniable fact. Physical silver is near impossible to source right now. Bullion Star just said it. Mints closed. Refineries backlogged. Competitors empty. They had to lower their buy and sell minimums from 20,000 Singapore dollars down to 10,000 just to maintain access for retail customers. This isn't paper volatility. This isn't a chart pattern. This is physical scarcity. You can't fake closed mints. You can't fake empty refineries. You can't fake dealers lowering minimums because they can't source enough metal to meet demand. When the physical market is this tight, when supply has been drained to the point where major dealers are scrambling, and the paper price is sitting at $85, the disconnect is extreme. It's unsustainable. One of these markets is wrong. Either the paper market at 85 is fake, a fiction created by forced liquidations and margin calls, or the physical shortage is fake, a narrative being pushed by dealers to justify higher premiums. But you can't have both be true. And the evidence overwhelmingly suggests the paper market is the lie. Look at Shanghai. The spot price in Shanghai closed at $100 today. The futures price in Shanghai is at $101. Meanwhile, Western spot and futures are at $85. That's a $15 premium, an 18% premium for physical metal in China versus paper contracts in New York. After a 40% crash in silver, after the largest percentage drop in modern history, the premium is compressing. But it's still elevated. It's still 18%. Physical is still trading significantly above paper. Why? Because in Shanghai, you're buying actual metal. In New York, you're buying a promise. And promises don't build solar panels. Promises don't manufacture EVs. Promises don't run factories. And the central banks know this. Central bank gold demand remains incredibly strong. Central banks purchased 328 tons of gold in 2025. That's just slightly below the 345 tons bought in 2024. Poland led with 102 tons. Kazakhstan followed with 57 tons. But here's the number that matters most. Gold acquisitions by central banks have continued for 33 consecutive months, 33 straight months of buying. No pause, no hesitation, no concern about price. The 12-month moving average for central bank gold purchases stands at a massive 27 tons per month. This is not speculation. This is not trading. This is accumulation. Strategic, deliberate, relentless accumulation. The central bank gold buying supercycle shows no signs of slowing regardless of price fluctuations. These are sovereign institutions with multi-decade time horizons. They're not worried about whether gold goes up or down 10% this month. They're worried about the long-term viability of fiat currencies, and they're voting with their reserves, buying gold month after month, year after year. And it's not just central banks. David Hunter, a credible macro analyst with a track record of major calls, just raised his gold price target from $5,500 to $6,800. He raised his silver price target from $125 to $180. That's a significant analyst raising targets while everyone else is panicking, while retail is selling, while the paper market is collapsing. The smart money is raising targets. That's a signal that the bottom is close or already in. This doesn't happen by accident. Look at COMEX open interest. This is the number of outstanding futures contracts across all delivery months. It's a proxy for how much leverage is in the system, how many speculative positions are open. And right now, COMEX open interest is at multi-month lows. As of Monday, total COMEX gold open interest dropped to just 414,756 contracts. That's the lowest level since June 9, 2025. COMEX silver open interest fell to 142,368 contracts. That's the lowest since May 20th, 2025. Open interest at multi-month lows typically signals capitulation. The weak hands are flushed. The leveraged longs are liquidated. The forced selling is done. When open interest craters like this, bottoms form. Not always immediately. Sometimes the price chops around for a while. But the forced selling pressure is gone. The margin calls have been met. The liquidations are complete. The system has purged the excess leverage. And once that purge is finished, the only direction left is up. Let me show you historical context. Gold price during Germany's hyperinflation from 1914 to 1923. The gold price went up 1 billion times. 1 billion. But the monthly volatility during that period ranged from minus 30% to plus 160%. Even with perfect foresight, even if you knew gold was going to 1 billion times higher, you would have experienced gut-wrenching volatility along the way. This is normal in precious metals bull markets during currency crises. The volatility isn't a bug. It's a feature. It's part of the process. It shakes out weak hands. It punishes leverage. It tests conviction. But the trend remains intact. And fundamentally, the gold bull era is 100% intact. The story being pushed by mainstream media is that because the new Fed chair will supposedly keep decision-making independent from the US government, gold needed to fall $200 per ounce, and silver needed to fall $50. In a nutshell, the story being told is 100% nonsense. 3 billion gold-obsessed citizens of China and India, plus a small band of savvy Western gold bugs, don't base their buying decisions on who runs the Fed. Their focus is on building savings in gold, not adding more fiat debt. The bull market thesis doesn't hinge on Fed policy. It hinges on whether the underlying fundamentals remain intact. Debt levels, currency debasement, physical supply-demand dynamics, and nothing in those fundamentals has changed. The $71 low in silver has historical significance as a previous support level. The silver crash was amplified by leveraged positions getting liquidated, which is typical in volatile bull markets. Gold bottomed around $4,400. Silver found support around $70. Whether those levels hold long-term requires more data and price action to confirm, but the initial bounce off those lows was violent. 20% in silver, 7% in gold. That's not normal bear market behavior. That's short covering, that's capitulation, followed by a snapback. And then there's the Chinese yuan. The yuan just hit its strongest level against the US dollar since May 2023. The yuan is strengthening while the dollar weakens. This supports higher gold and silver prices in dollar terms. The pricing power is shifting east. China is accumulating. Central banks are buying 33 months straight. Physical metal is impossible to source. Mints are closed. Refineries are backlogged. Dealers are lowering minimums just to maintain access. And the paper price is at $85. Someone new. So is 71 the bottom? Here's what the data says. If we reclaim $90 and hold above the 150-hour EMA at 96, that's bullish confirmation. The bottom is in. We're heading higher. The rejection at 87 to 90 was just a test. The bulls regrouped. They're coming back for another attempt, and next time they'll break through. But if we fail to reclaim $90, if we start testing 80 or below again, more downside is coming. The 87 to 90 rejection was a warning. The bulls tried. They couldn't hold. The sellers are still in control. And we might need to test 71 again, or even break below it, before the true bottom forms. The technical picture is mixed. The rejection at 87 to 90 is bearish. The open interest washout and physical scarcity are bullish. The 150-hour EMA at 96 is key resistance. We're trading $11 below it. If we reclaim it, bullish. If we fail, bearish. But here's what matters most right now. The physical market is saying the bottom is close or already in. Mints closed, refineries backlogged, dealers can't source metal. Shanghai premium at 18%, central banks buying 33 straight months. COMEX open interest at multi-month lows, David Hunter raising targets to 6,800 gold and 180 silver. These are bottom signals. These are capitulation signals. These are the signs that the forced selling is done and the turn is near. But the paper market is saying more volatility is possible. Bitcoin below 74,000. Bond yields spiking globally. war with Iran escalating, risk-off sentiment spreading, the 150-hour EMA at 96 acting as resistance, the rejection at 87 to 90. These are continuation signals. These are the signs that the selling pressure hasn't fully resolved yet. This move was prepared, and the unresolved tension between these two markets, the physical and the paper, is what creates the explosive potential. If the physical shortage is real, and all the evidence says it is, then the paper price at $85 is absurdly cheap. It's a gift. It's a window that won't stay open for long. But if the technical breakdown continues, if Bitcoin keeps falling, if bond yields keep spiking, if Iran escalates into full war, we could see one more flush lower before the turn. We could test 71 again. We could even break it. And that's where you have to decide what kind of participant you are. If you're a long-term stacker with a time horizon of years or decades, this is all noise. Daily swings, hourly charts, EMA tests. None of it matters if your thesis is monetary debasement, industrial demand growth, and central bank accumulation over the next 5 to 10 years. For stackers, the only question is, can you source metal, and is the premium reasonable? Everything else is just volatility you ignore. You buy when you can. You hold what you have. You don't trade, you don't leverage, you stack. But if you're trading, if you're using leverage, if you're playing short-term moves, then every level matters. You need to know where resistance sits. You need to know where support breaks. You need to understand risk-off dynamics and how geopolitical events impact price action. You need stop losses. You need position sizing. You need an exit plan, because this volatility can wipe out accounts before you have time to react. Leverage kills in markets like this. Even physical holders need to understand that premiums can collapse as fast as they spike if the paper price falls far enough. Nothing is guaranteed. Not the bottom, not the bounce, not the breakout. This is war-driven price action. Geopolitical events are unpredictable. Headlines can reverse in hours. What looks like a breakout today could be a bull trap tomorrow. What looks like a bottom could be the midpoint of a larger correction. So here's what I'm watching, the 150-hour EMA at $96. That's the line in the sand. If we reclaim it and hold, the bulls are back in control. The bottom is confirmed. We're heading toward 100, then 110, then higher. But if we fail at 96, if we get rejected again like we did at 87 to 90, then the bears still have control. And we might need to test lower levels before the real turn begins. Current prices as I'm recording this: Western spot and futures at $85, Shanghai spot at $100, Shanghai futures at $101, the premium is $15, that's an 18% premium. After a 40% crash, the premium is compressing, but it's still elevated. Physical is still trading above paper. The disconnect is still real. COMEX open interest just hit multi-month lows. Gold at 414,756 contracts, lowest since June. Silver at 142,368 contracts, lowest since May. When open interest craters like this, it signals the washout is complete. The weak hands are gone. The forced selling is done. Historically, that's when bottoms form. Combine that with the physical scarcity. Bullion Star saying silver is near impossible to source. Mints closed. Refineries backlogged. Competitors empty. This is a structural shortage colliding with a paper market crash. And when those two forces collide, the resolution is always violent. Either the paper market capitulates and prices rise to reflect physical reality, or the physical shortage eases. One of those outcomes happens. All evidence points toward the first. Time is running out. Understand the risks. Premiums are elevated. You're paying 18% above paper if you're sourcing from Asia. That premium can compress if paper rallies. But if you're buying physical now, you need a long-term horizon. You're not buying for next week, you're buying for next decade. If you're trading paper, futures, options, ETFs, the risk is different. Leverage risk, liquidation risk, counterparty risk. The paper price can disconnect from physical reality longer than you can stay solvent. You can be right about fundamentals and still get wiped out by short-term volatility. Know your risk tolerance, know what you can lose. This environment can destroy accounts in hours. If this continues, the price won't be the real problem. The real problem will be sourcing physical metal at any price. Bullion Star is already saying it. Silver is near impossible to source, mints are closed, refineries are backlogged, competitors are empty, and that's with the price at $85. What happens if the paper price rallies to $100? What happens if it goes to $120? The physical shortage doesn't ease. It gets worse, because industrial buyers aren't price sensitive. They need the metal to run their factories. They'll pay whatever it takes. And when industrial buyers start competing with retail stackers and central banks and speculators, the premiums explode. The delivery times extend. The availability vanishes. We're watching the early stages of a physical shortage that could lock retail buyers out of the market entirely. If you want metal, if you believe the thesis, if you think central banks are right and the paper price is wrong, the window is closing. Not next month, not next quarter, now. while dealers still have inventory, while premiums are elevated but not insane, while you can still get delivery within a reasonable time frame. Because by the time the headlines admit there's a shortage, by the time mainstream media covers the closed mints and backlogged refineries, it will already be too late. The metal will be gone. The premiums will be 50%, 100%, 200% over spot. The delivery times will be measured in months, not weeks, and you'll be sitting on the sidelines watching the price run while you can't access the physical asset at any reasonable cost. That's the endgame scenario. That's what happens when a physical shortage meets a paper price collapse. The divergence becomes unsustainable, and the resolution is always the same. The paper price eventually capitulates and rises to meet physical reality. Or the paper market loses all credibility and traders abandon it entirely, moving to physical-only markets. Either way, the people holding physical metal win. The people holding paper promises lose. By the time the headlines admit it, it will already be too late.